Okay, hello and welcome everyone to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, March 31st. Good to be with you guys today. We just got the release of the initial jobs claims for the United States, coming out slightly weaker than expected. A bigger claim count here, 276,000. Continuing claims slightly off, down by a good 100,000 or so, not even 25. So kind of a wash on that print. Again, tomorrow is the highly anticipated non-farm payroll print, which of course is a much more extensive read from the government, and we'll be looking forward to that. Keep in mind, again, I cannot stress enough, guys, it is the last day of the month, last day of the quarter. Really wicked stuff can happen in near-term price action in these market conditions, so we do want to be very mindful of that. Eileen, glad to see you this morning as well. Hope you did the right thing by the defendant. So jury duty went as planned. Civic duty has been completed for the next 3 years, Eileen. So hopefully we don't have to go through that for a couple of more years. But good to see you guys here. David, Graham, Hussein, Madad, Mark, Nikolai, Tabor. Great to be with you guys this morning. So we got a lot to cover. I've been putting out reports all week long, but we haven't had any webinars to go through them. So I'm going to try to cover all the reports from this week. If there are any pairs or specific questions you have, as usual, guys, feel free to post them at any point. Today we do get comments from the Fed's Evans. Charlie Evans will be speaking later on the economy and policy in New York. That's at 9:45, so keep your ears peeled for that. But on the back of the comments, we never had a webinar in the back of the comments said by Yellen, and I did try to highlight those comments a few days ago here with this report on the 29th. The major takeaway from the comments that Yellen said was basically QE if needed, and markets really hung on that. You saw that equity markets rallied. You saw that dollar took a big tumble. We've been tracking the Fed futures funds rate. This is how it looked earlier in the month. On the 15th, you saw pretty much June come up as the probability for the next nearest term rate cut. After Wednesday's comments, that got dropped. Okay, next expectation for a real interest rate hike moved down to November. Okay, and this is suggesting, again, on those comments, market participants are pushing out expectations for higher rates. That's going to be bearish for the dollar. Now, if we look at this here today, here's what the Fed futures rates look like today. Okay, and you can see even a bigger change now from November, dropping down to 46%. Now looking for the next probability of rate hike, not till December. Guys, when we opened 2016, the expectation was for 4 interest rate hikes. Now markets are pricing in practically 1 in June. Now, it's important to note the caveat, these do change on a daily basis. We could come back on Monday, we could find that the 55% is moved up to November, but you're seeing the tendency, okay? You're seeing the tendency from the 15th of the month to the 29th of the month to right now. Market expectations continue to kick out those interest rate expectations for higher rates this year. So shouldn't be too surprising to anyone to see what the dollar is doing. Now, from a price action standpoint, here's the dollar index looks like today. Whoops. Okay, broader returns, you can see that the dollar is broadly weaker against all its major counterparts. Sterling with a slight decline here, 0.2, but biggest gainers on the session, Euro, 0.42% in the black, CAD, 0.44% in the black, and the Swissy with a gain of 0.53. With that said, let's jump into price action on what the markets are doing right now. So here's the dollar index looks like on the daily chart, guys. And this is something you've seen a couple of times this week. I'm going to move this over to the side here and bring over the intraday chart as well, just to show you sort of where we are in trend. And I just wanted to highlight one thing. Remember, early in the week, we noted that we were looking for a high earlier in the week to sell. Okay, we're coming into the upper median line parallel. It was a clean 50% retracement of the decline off of that late February high. You also had that last swing high that you made earlier in the month on the 24th, and they all coincided right here. Well, on that day, and I even noted it here on SB, we had an outside day reversal off of resistance. These can be very telling, especially when the outside day reversal is coming off of a major resistance confluence such as here. So we were inherently looking down, to the downside rather. The break that we were sort of looking to solidify was a move below 11,970. That's a 50% retracement. This is off the advance from the low that we made in late May of last year. And it also would have necessitated a move back below this long-standing trend line, guys. And I showed you this a couple of times. Former channel resistance, now support. We've been pivoting off it. You saw a support bounce earlier in the year, or last year rather. We even tried to bounce off it earlier this month before falling through. Again, that solidified the reversal, looking lower. So your near-term support targets now, you have the median line parallel again, which is coming into play, and the stretch low that you made from October. That basically takes you to 11,854. Also note, momentum back below 30. If we had broken above, or 40, excuse me, if we had broken above this 40 and found support at 40, I'd be very hesitant to try to take any type of short bias on this. But now that we're back above 40 on a closed basis, yet again, confirms the momentum signature remains bearish in the dollar index. For the, I'm messing with my levels. For the near-term bearish invalidation level, that's right here at 11,985, and that's simply the outside day reversal close, which also coincides with that upper median line parallel over the next 2 days. I know it doesn't give us much help. It's very far from where we are right now, but we need to know the levels that would invalidate our bias. And as long as we stay sub 11,984, 985, I am looking lower here in the dollar index. Near term, heading into Friday, okay, heading into the end of the month. Let me take that back. Ahead of Friday, guys, just because it's Thursday, it's the last day of the month, last day of the quarter, what should we be expecting heading into the U.S. session today? Pretty radical price action. Reduce your leverage on any positions that you're taking for the next 48 hours. Again, market liquidity tends to thin out. Sometimes you see a lot of radical price movements. You have a lot of adjustment in closing and rebalancing of balance sheets heading into the new quarter. So just be careful. The 30-minute chart looks like this. And we tacked this on earlier in the week. We posted it on SB. Continues to hold pretty well. I mean, the rebound that we saw found resistance at the median line. The break charged a rally right back into the upper median line parallel, or just about, and the pullback right at the median line. So near term, we're going to continue to favor, or we're going to continue to look for resistance rather along that upper median line parallel. If this gives out, I would expect a little bit of a near-term pullback here to the upside for the dollar index. Keep in mind, again, we've been marking some divergence into these lows. Price action, again, bringing it into a line chart. Oops, no one wants to see that. Price action making a lower low, the oscillator making a higher low. Okay, so you did get that up thrust. We'll see if we can get a trigger here to the upside, but at the end of the day, you'd be very cautious about trying to chase the dollar lower at these levels at this time of month, more importantly. Okay, we're coming off the back of a 4-day stretch to the downside, or today would be 4 if we close lower. So use some caution. This actually coincides very well with what we're seeing on some of the dollar crosses. Okay, Aussie dollar looks a little bit tired up here. I do think you get a pullback in the Aussie dollar. Sterling, same thing. Love the upside of the sterling in general. Funny quick note here I'll give you guys. Yesterday, while I was in court, I was being cross-examined by the judge for jury selection, and when the judge found out that I was in the currency markets, he literally put the whole hearing on sidebar, and he said, "Hey, what do you think about the pound? I'm traveling in 3 months." So it's interesting to see how the real life effects of these exchanges and how people are so interested in them. He was under the impression that the sterling should continue to fall because of what's happening in June. And so we actually took a good 20-minute time out of the court for me to explain, look, the referendum in June might in fact cause a sterling sell-off. I don't know. My personal opinion, if we do get the decoupling from the pound in June on that referendum, or decoupling from the Eurozone rather, I think that has larger implications for the euro actually than necessarily the pound. So I continue to postulate my opinion, which is sterling is constructive from here. So we had a good discussion on it. But anyway, back to business. Quick funny note there. Looking at the British pound from where we are right now, here's what the sterling looks like. And again, you're kind of finding some resistance here back at that uncovered gap. It's not uncovered anymore. We did cover it back here earlier in the month on the 11th, but it's continued to be a decent pivot in price. Okay. Eileen says he needs to buy those pounds now. Yeah, maybe on a pullback, it might be a good idea for sure. But from here, guys, I do think the risk is for a near-term pullback. You inevitably want to buy that pullback. Here's what the 30-minute looks like. Okay, and I just wanted to note, again, we talked about this earlier in the week, divergence into the highs. Saw this thing come into support yesterday. We got a little dribble lower. My favored entry, if we could get it, would be a drop back into this region here. Okay, basically a 50% retracement of the rally off of the lows that we made from last week. You also have basic trendline support off the lows, but wait 1 second, stop traffic. That slope, ladies and gentlemen, turns out to be the same exact slope as the channel that we were working with earlier in the month. Okay, and if you take that, you just copy that line, that parallel, and extend it, you can see that it was the exact trendline support here. So continuing to suggest that we do have the operative correct slope to the upside, a pullback of that magnitude, the 50% converges right around 42.57, 42.58. Okay, don't know if we'll get it, but that would be sort of the entry point of which I would start to look back for long exposure. From here, not really interested in trying to take longs into the end of the month. If we get a convincing long trigger against the lows that we made last night, maybe it might be worth it. But again, we want to reduce our leverage, guys. I really can't stress enough. I've been stung so many times on these end of quarter flows. It's not even funny. So just, especially if we've had a good week or if we've had a good month, we just want to make sure that we're keeping the powder dry here as we head into a little bit more trading difficult, trading conditions. Any questions on the pound? Here's what we looked like last night. So you did get a quick dribble below that. Didn't get much momentum. 40 held in the RSI signature, which is something you want to see. But here we are failing at 60. And again, you might get some more back and forth. Broadly speaking, looking for a move lower here to get back on the long side. Any questions on the pound? Also, remember one thing, guys. A lot of these trades that have given us an opening range break, to the upside, it's Thursday. So, typically you look for those opening range breaks to give you the high or low late in the week on a Thursday, Friday stretch. With the dollar doing what it's doing, and with NFPs on tap tomorrow, again, you might see some of the recovery on some of these dollar short positions offer some base support for the greenback. And let me just take a quick look at what the pound is doing near term here. Again, some divergence into the highs here on the 5-minute. See if we can't get a pop higher. Try to get a possible short position here. If we do take a short position on a pop higher, guys, the stop would need to be against the highs that you made in a European trade. So as long as you can get that within 37 pips and you get a good trigger, the limit would be right back here. Initial targets, if we break lower, like I said, first target would be the 43.05 level. And then this is an area of which we would start to look again for possible long exposure. All right, so moving right along, that is the dollar index. We got a lot to cover today. And sterling, let me cross that out. Dollar index is crossed out. All right. Next up from yesterday's radar charts, we'll go through these real quick. Aussie Kiwi, I think, is primed, and it's something I'm very interested in watching on the near term. So let me just walk you through the daily chart first. It's pretty self-explanatory, but you're coming into some very interesting areas. So for the pound, or for the Aussie Kiwi rather, it looks like we're making a correction lower off the highs. Okay, you got some divergence into the highs. This completed an 88.6 retracement from the decline off of last year's high, essentially. Yep, right off last year's high. And we're simply looking to play the correction to the downside. The daily chart, all it's highlighting here, and all I really wanted to stress, is just the close highs for November, the 618 retracement of that same decline. And if you go, for those of you who have been on SB for a while, I know you guys haven't forgotten this slope, right? If you're laughing at home, I know what you're talking about. We talked about this slope at length, at nauseum, for a couple of years now. This is the slope off the 2014 initial lows that you made for the first half of the year. And the same slope continued to be an operative pivot in price for the entirety of 2015 trade. So here we are again, that same operative slope. It's the actual operative one off the 2014 initial range low comes now as resistance. And I'll show you this on the daily chart and on the 30-minute chart in a moment, does having us tagging that resistance earlier today and holding. So that's right around here, just beyond the highs that we made today. And the risk is lower while below that region. Inevitably, we would be looking to buy this, but right now, the downside bias remains well below this region. Here's the 30-minute chart. And here's what we looked like yesterday. Okay, and the basic premise was the median line extending off of the near-term highs here. Okay, you have the operative slope in blue. You have a sliding parallel here off that secondary high, and that's exactly what converged on that longer standing pivot slope line we talked about on the daily chart. That's what this is right here. I know you can't see it as clearly because of the slope, but it all coincides right here. So the high that we made heading into the Asia trade last night was perfect. That's going to be the near-term resistance range. A break above this, you're looking for the 50 line, which has also served some pivots here in price. And this is what's going to be the near-term bearish invalidation. So even in the event that you do get a topside breach above 111.12, I'd be looking for short triggers into that 50 line. Long story short, key support, again, on the near term, I know we're looking at that 50% retracement on the longer term chart, but here's the 30-minute with just a basic retracement off the lows from February. And that 38.2 comes in right at 1040. Just below that, you have the November high day close, and that's at 110.16. Okay, so the levels are exceptionally clear. Again, for those of you, I see a packed house here today, guys. If those of you who are new to the room, do feel free to click on the camera button in the top right-hand corner of your screen if you want to take a freeze shot or freeze frame of any of the charts that you see presented here today. Now, it serves really well with what we're seeing in the Aussie dollar. And I want to take a quick segue into Aussie dollar now that we're talking about Aussie Kiwi. But certainly a pair. It's got a nice 25 pip ATR right in our sweet spot in our butter zone there. Near-term key supports not till 110.40. So if we do get a nice trigger break, especially if we clear the opening range lows for Europe and Asia, guys. We're already trading below the Asia lows. But if we clear the opening range low for the United States, for Europe, that would be a nice trigger, I think, to the downside. Again, looking for an inevitable move towards that key support threshold. Okay, and don't forget also with the Aussie key, just lower. Okay, I know that we have that 38.2 at 110.40 that I talked about, but look where the 50 line of the operative slope converges, right on the November high day close. Okay, and that's 110.16, 110.17. So just keep that in mind if we do see a move lower. Any questions on Aussie key? This one's going to be one that we're going to continue to revisit, guys. I really have a lot of faith that this is going to give us a really nice position. Okay, so that is Aussie Kiwi. We are running awesome on time here. Okay, moving into the Aussie dollar. And certainly the update from that, I believe, was on the 28th, if I'm not mistaken. Yes. All right, so here's what Aussie looked like early in the week. Basic key resistance, 76.43, 76.50. We made it through that region, but still, the sliding parallel for the operative slope we're working with the Aussie caught that high again. So here's what Aussie dollar first looks like on the daily chart. It looks like we're trying to probe through it again. Okay. One thing I want to note is you're still marking divergence into these highs. Okay. RSI making slightly lower low. This is a much more dramatic lower low as price action has made a higher high, and a higher high. Okay, so the risk is still there for a pullback. The broader trade remains constructive. We're going to go ahead and raise that bearish invalidation level, or bullish invalidation level, excuse me, up to 74.77, which again is the basic 236. But more importantly, it's that former upper median line parallel that we broke out of a couple of days ago. Here's what Aussie looks like on the 30-minute chart. Now, to be fair, I don't have any topside objectives beyond here, guys, from a scalping standpoint. If we clear this median line, there's really nothing on tap until you get up into basically the 78 handle, 78.05. Just trying to figure out what level that was. All right, we're going to want to stress this the high day close here for June. That still takes you into 77.94. Let me adjust that level on the 30-minute. $77.94. Okay, So it is a long way to the break to the upside for about 100 pips if we make it through. But that's the nature of a major key resistance, especially a slope line that has continued to offer clarity for that long. So again, just to recap real quick where we are in price. There's the 5-minute chart. Again, this is from the 28th. You can see that near-term ascending channel formation was textbook. The pullback, literally, guys, right back into that sweet spot. By the way, 75.08 is the weekly open. So you came back, checked the weekly open. This break, especially when the weekly open offers support, this break constitutes a simple break of the initial weekly opening range. So right off the bat, you had a long bias with a break back above, especially the upper median line parallel here. As you can see, obviously all the targets from that report got taken out. So right now, again, this is just a soft target here at 76.77 or 76.79. That's just simply the monthly high that we made prior to this break. And again, there's that slope line that we'll be watching so closely into US trade today. Not interested in long side exposure for the Aussie, at least from here. Okay, like I said, it's the last day of the month, last day of the quarter. If anything, with event risk on tap for the US dollar tomorrow, I would be more inclined to see some dollar strength here today, at least on a little bit of a recovery from the 4-day decline that we've had. Any questions on Aussie dollar or Aussie Kiwi for that matter before we move off? Okay. I do want to take a moment. I forgot to cover pound yen after we talked about the sterling. So let's just take a quick look at what that's doing. So obviously we talked about pound. Again, likely possibly see another little bounce here, but broadly we're looking for a move lower. Would like to get long from down at 42.50, 42.60 region. Looking at pound yen, getting a little bit more of a pullback here, but continues to hold a pretty clean pattern. Okay. Yeah, that's right. So you have a basic trigger support here, which we'll be watching. Momentum still holding sub 50, so we don't have the breakout, at least in the momentum signature yet. Note that this thing hasn't broken 50 this year. So the break above 50 would certainly be a change in behavior for momentum, and we'll be expecting that. Near term, looking for support along that lower median line parallel. Here's what it looks like on the 30-minute chart. Let me just snap these levels for you. Okay, so let's update this a little bit. We're going to bring our near-term support target to right here at this confluence support, 160.75. And key resistance is still going to be along the high. I know that there's a 764 retracement here, guys, but along the high for the week, which converges again on that upper median line parallel. So something to keep in mind. Excuse me. Hey, Mike, after you finish your list of pairs, would you take a look at the Euro key for me? Thanks. Craig, absolutely. Let me write that down. Okay. Sorry about that. So, again, the near-term price action. Here's what I was looking at since the start of the week, and you can see that the parallels, although they have caught some really nice pivots in price, getting a little messy here at the upper median line parallel. Long story short, we haven't closed above it yet. So here's the pullback. Again, we're looking to stay constructive above 160.75 in sterling yen. A drop there, again, might offer a nice opportunity to get long. The momentum signature hasn't really turned over that much. You got a quick dribble here below 40, but nothing to write home about just yet. So for sterling yen, again, here's what we looked like earlier in the week. We're trading right into that 161.92 region. We've redone the levels. Okay, just a tad. So there's that 161.92 that hit. Again, our final target was supposed to be up here at 62.76, 62.75. We just came short of it with yesterday's high, essentially coming at 62.56, a couple of pips away. So you're getting the pullback now. Again, remaining constructive above 160.75, looking for long triggers here. A topside break. You're looking for a final rally into that 62.76 region. Nice wider range ATR. So for those of you who are a little bit more comfortable with the intraday strategy, you got a lot more meat here on sterling yen. Okie dokie. I do want to cover all the dollar crosses today. So we've gone over Aussie dollar. I do want to look at really briefly Euro dollar. I'm not a big fan of where Euro's trading still or how it's trading. I love the upside. I don't know if there's a tradable range or a tradable level for us to try to get long at, but we'll look at that. And obviously dollar CAD, which is coming off of a pretty big region. So let's jump into the loonie first. And if I'm not mistaken, that was the update from the 29th. Yes, it was. So here was dollar CAD. Okay, and we had noted a couple things for the dollar CAD. Here's what the scale chart looked like. Back on the 29th here, we were heading right into this. We were straddling this region, the 618 retracement of the entire advance, and a former trendline resistance, turn, slope support. And we were straddling right there. The momentum signature, however, was extremely bearish since the start of the week. And with what's been going on with the comments from Yellen, which are obviously, it was kind of a wake-up call to markets, right? The fact that they're even bringing up QE when we just hiked rates in December, right? And they're saying that, yes, the inflation picture looks pretty bad, but we might still, inflation expectations are expected to move higher. There's still global risks. And in the meantime, you have all the global central banks across the pond there moving into negative rates, doing more easing. So yes, her coming back and having to pad the conversation by even bringing that up, I think that's exactly what risk markets were looking for. So long story short, $4 CAD, let me bring that chart up real quick. Here's what the daily chart looks like first. And here's what the daily chart looked like earlier in the week. Big, 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 big support at 29.65. I really can't stress it enough. So let me just snap these levels real quick. Okay. So just a couple of things I want to note for you of how critical this level is in dollar CAD. First of all, you had 100% extension from the decline off the highs. That gives you 29.65 or so. You had a 618 retracement from the ascent off the lows. Really nice confluence of Fibonacci levels. You had the 50 line for the current operative descending channel formation. That caught the lows. More importantly, and sort of a little slider here that no one knows about, if you go back far enough, and you take just this basic slope of these two reference points for the 2011, 2012 lows, okay, and extend that same slope to the low off of the 2006 dip to the highs from 2008, 2009, you can see that the slope is identical, right? Now look where this median line comes into play. Support, 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 breakthrough, resistance, breakthrough, resistance, 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 breakthrough, support. Wait 1 second. Right now converges on that same exact level we're trying to break today. And what I can say to you is this, guys: if dollar yen or if dollar CAD closes below 29.65 on a day like today, you're at risk. You're seriously at risk for seeing this thing drop. You've got just the basic low day close for October, and that swing low you made in July coincides very nice with sort of the highs that you made here in early 2015. That takes you at a soft target into like 28.60, 28.50. More importantly, a basic 38.2 of the broader ascent. This is off the lows that you made way back pre-crisis, right, 2007. That converges on a whole host of longer-term former trendline resistance, former channel resistance, and that 38.2 all converge down here. And dependent on where we are in time, it actually might also coincide with that median line. Okay, that gives you a key range of support somewhere in the range of 25.37 into 25.66. Now that's, guys, that's if we make it past this 28.60, 28.50 level. Okay, so that's the first sort of major key support you'd want to look for. Bearish invalidation for the current operative bias is with a move and a close back above 29.65, 29.76. We need to get back above this region. Note one thing, divergence. This is why I can't really advocate getting short at the low range of the yearly low here. And we don't want to be trying to call bottoms. It's just not a smart move, okay? But we know what to look for. It's going to be that pop through 29.76, 29.65, this region, and that will put us on a buy the dip mentality. Or on a break below this, I would be looking for a rally back to test that median line as resistance to get back on the short side, looking for inevitable drop into this key region. Okay, so right now the bias is neutral. Okay, we don't want to necessarily be selling at the lows, and at the same time, we don't have conviction of this being a bottom just yet. Today's U.S. trade session, specifically heading into non-farm payrolls, I do think you get a strong tell on this trade. That being said, you don't want to try to fight this. You're still looking lower either way. Either way. Now you can see a scenario where. Actually, give me one sec, guys. I didn't have the median line in there. Okay. Okay, so these are just some soft targets, guys. If you are holding position here, 28.66 is the low day close. I'm sorry, 28.61. And this is, no, we're not going to want to watch that region. So watch 28.61 as the initial kind of soft support there at the low day close. That's the low day close again from the drop that you saw here in October. It's the initial support structure. Key resistance near term 29.65. A break lower. Look for a region near 25.60, 25.70. Any questions on dollar CAD before we move off? Ever since the buys shift here earlier in the week with the break lower, I've been looking for a short trigger. The only one I got was after Jury Duty one day, actually, on this move here into the open of Asia trade. Or this was actually deep into the Asia open, actually. And that got us a nice 36 pip drop, which we got out just below that 130.20 level. Haven't gotten any positions since, and I am still looking for a near-term low here, a rebound to give us a recovery. I think if we get back into that former resistance that you see here in red, it might be an opportunity to get back on the short side from right here. Again, with the divergence that you're mounting into the lows, just be cautious. Okay, just be cautious on a little bit of a snapback. Broader trade remains bearish. Hey, Mitten, great to see you in the room. And ho, cheers. All right, so that's dollar CAD. Now that we're talking about dollar CAD, I do want to talk about crude real quick. That's a nice sort of crossover that you want to keep in mind when you're watching these pairs. Crude oil looks like this. I actually posted a chart on it on last night's radar charts. Here's what crude looked like last night. And here's what crude looks like today. Same region of support I want to highlight, 37.91. We're trading into that right now. It's a basic 618 extension from the decline off the highs. You have a basic 236 off the lows. That gives you 38.13. So you got a nice 20-cent range of support that we're testing here today. What I wanted to note on this, just a couple of things, is this has now completed a 5-day decline. 1, 2, 3, 4, 5, 6, excuse me, a 6-day decline. Did I note that yesterday? Yes, 6 down days in a row. Sorry about that. And today would be 7 if we got it. And I just wanted to go back and look and see when the last time we got consecutive declines of that amount. This is an indicator called consecutive bars. Again, you can find this on fxcodebase.com. It allows you just to be able to track how many times we've seen consecutive down days in a row. So it's not counting the operative days. So it's going to show 6 ahead of today's close, which would be 7. The last time we saw 7-day declines was right here. A very small interruption, a blip before we connected lower. We saw it again in November of last year, a quick blip before we inevitably pressed lower. It did charge a rebound, okay, but subsequent to the 7-day decline, it was just a one-up day before we moved off. And that's sort of the last two primary examples of times of which we've seen 6 days or more of consecutive declines in crude. Got to go way back to 2014, July of 2014, to see the last time we've had a consecutive decline of that. And the same thing happened. You got a single day recovery before connecting lower. So my point being is, guys, you could see a little bit of a hold here. Wouldn't be surprised specifically. This thing has been moving with the dollar, oddly enough. So specifically, if dollar takes a little bit, yeah, Minho, no problem. It says, can you have a large screen for oil? Sure. There you go. Let me make it nice and pretty for you. Hold on. There you go, Minho. Feel free to take a picture, man. It's the same chart from yesterday. It's just updated with price, but this is pretty big, okay? And if we get a drop, honestly, there's nothing. There's really nothing until down here, 35.80 into 35.55, which is the 100-day moving average. So you have a lot down here, okay? Hey, Minho, you're more than welcome, man. You have a lot down here. A basic 38.2 of the advance, a basic pivot line, support, instant resistance, breakthrough, the 100-day moving average, and the lower median line parallel, all converging in this region, just right around 35.50 and 35.80. So big region of support here for crude. Long story short, if this doesn't hold, especially on a closed basis, more importantly on a closed basis, expect further declines in crude prices. All right. Any questions on that? Near-term resistance, you tagged it yesterday, 39.79, 39.80. It's a longer dated 786, but it has offered some really nice pivots. And bearish invalidation for the operative immediate bias is up here. You have the median line off the low. You have the 200-day moving average. A 618 retracement from the decline off of the October high. And more important, I don't have it highlighted, but it is the high day close. I guess I can put that there. It's going to get a little messy, but you guys get the picture. Okay, so there's the HDC right there, all converging on this region between 41.17 to 41.40. So for me, the levels in crude are exceptionally clear. Exceptionally clear. I'm loving it. I'll have to see what we do today. Again, last day of the month, last day of the quarter. Use some caution. Okay. CLN CAD not trading correlation, says Tabor. No, I guess you could see that by today, right? And that happens, Tabor. We want to know when these correlations are strong and when they're not so strong and when it's really emphasized. And right now what we're seeing is CAD strength and crude weakness. I'm sure some people, their minds are blowing, but that's just what markets are going to do sometimes. This is all CAD strength. All CAD strength. By the way, Tabor, a good point that you bring up. These decouplings, okay, and typically quote-unquote strong correlations, these are typically onsets or precursors that you see at major market turns. Either crude continues to appreciate and the CAD trails off, one of them is lying and the reversal happens, or vice versa. So this is why, again, heading into the end of the quarter, heading into the end of the month, with what's happening in the decoupling here, with crude prices continuing to tail off as the loonie appreciates, one of these guys is probably lying, and you'll probably see the onset of that as we head into the next quarter, as we head into next month. So Tabor, keep your eye on that correlation. You know me, I'm not really a guy who wants to stress correlations, especially in near-term trading, right? We can easily get a swing where the dollar and gold are moving in opposite directions throughout the course of the day. It's not going to stop me from taking a scalp, but certainly on a broader basis like this, when you're looking at daily charts on a 4-day decline here in dollar CAD, that's CAD strength, and then you have a 4-day or a 5-day, 6-day decline in crude prices. Yeah, you want to pay attention to that. And again, a break in those correlations or a deviation in both of those outlooks certainly does tend to be a precursor to some major market turns. Is it paired with dollar like gold? So Eileen, good point. Is crude trade based on the dollar moves? So some of it is, and I think that you can assume that on the longer term. But again, not right now, Eileen, right? Not right now. Dollar. And guys, you don't need me for this. We could just simply look at the chart. Dollar's come off pretty strong over the last 4 days, right, Eileen? I don't think anyone's going to argue with me on that. Turned out that high on the outside day reversal was a perfect reversal. And then if we look at gold, well, let me take the gold chart here. Gold did see an up day, but yesterday dropped right alongside the dollar. Right alongside the dollar. And it was a pretty big drop, right? It's like $8 to the downside yesterday in gold as the dollar index also moved lower. So you don't want to stress those correlations, guys. I think gold, broadly speaking, now that you brought it up here, Eileen, I think broadly speaking, you're going to see a little bit more back and forth action. I do think gold, the broader trade remains constructive, especially now that you're seeing market participants really continue to kick out those expectations for higher rates. Okay. Again, I really can't stress enough the fundamental story for gold was pretty clear into the start of the year. Fed's going to move higher on rates. Gold does not pay a dividend. In fact, there is cost of carrying gold. And inflation remains low. So what are the major bids for gold? Historically speaking, you find it when market turmoil is really going on and people are looking to diversify into the relative safety of gold, which you're not seeing right now. And inflationary concerns. If people are worried about fiat currencies and rapid inflation, typically you'll see people look for a store of wealth in gold, right? You're not seeing inflation. In fact, we've continued to see the Fed say that inflation expectations might move down in the near term, although longer term expectations remain well anchored, quote unquote. So inflation bid is not there. Market correction or turmoil in markets, well, there's a lot of headlines going around, but broadly speaking, equity markets in the US are near the yearly highs. Okay? And higher interest rates, that's going to be bearish. Or that's going to be bearish for gold. We're not getting higher interest rates. In fact, we just look at the world interest rate probability on the Fed futures rates, and we saw that they're getting kicked out all month long. We're getting kicked out, those expectations. These are all constructive for gold, all of them, from a fundamental standpoint. So I am treating this as a correction in gold. I do think you can still see a move lower. The breakout or the near-term bearish invalidation level, in my mind, is still going to be up here at 1250, 1246. So 1246 is still going to be that high day close that you made from February. I know there's a new high day close, but guess what? The high day close for March is the same exact levels, the upper side of that range, and that's 1250. That's what we see here in dark magenta. So you've got the March high day close, the February high day close gives you a nice range alongside basic former support, now resistance, and the upper median line parallel for the operative slope. I mean, this thing can't get much cleaner. So yes, you could see some back and forth here, Eileen. Guys, I wouldn't want to get too wrapped up with trying to play the chop. You're either looking for a breakout above 1250 to validate, resumption of the broader uptrend, or actually, let me see what this extension looks like. Very interesting. Okay, so if this is just a simple correction, ABC sort of equal legs down, this is 100%. And it coincided dead on with that 786. You got a little striper below, but it was a reversal day. In fact, the high wasn't an outside reversal day, but it was a reversal day nonetheless. So key support 1210, 1211. Key resistance 1215 to 1246. That's really what you need to get the breakout in gold. Any questions on the gold trade? And again, just to give you a broader picture, here's what the weekly chart looks like for gold, right? There's 1193. That was our near-term bullish invalidation level, or medium-term. This was presented, guys, by the way, on the 2016 second quarter forecasts on Daily FX, which have been published since last week. So you're going to see that chart on there. Here's the updated region of it. You saw a nice bounce off that 60 region, right? And this is the first 60 that we've seen, first 60 break of magnitude since early 2014, guys. So something to take note of. Any questions on gold? Okay. Have you done Aussie dollar, Mitten? Yes, we did cover Aussie dollars, one of the first ones, Mitten, so I'll have this posted as soon as I can, man. And you can watch that at your leisure. So let me know if you have any specific questions. Craig, I will be at Euro Kiwi in just a moment. We did dollar CAD, we did crude, we did sterling yen. Let me just do CAD yen. We'll jump into euro dollar, and then we'll do Euro Kiwi, okay? Mitten, I appreciate that. So first things first, from yesterday's update, CAD yen. I didn't want to really put too many updates for today, guys, because I really, honestly, my personal humble opinion is you don't want to be aggressive on a day like today. But CAD yen, I think, is coming into such a paramount region here. You saw the same exact slope on Jamie's swing update from last night, and he couldn't have nailed it better. It's such a critical region of resistance that I'm looking broadly for a turn lower in CAD yen. Here's what CAD yen looks like. Sitting on hands, no traps of fingers for me, says Eileen. Yeah, not on a day like today. Prudence pays on a day like today. CAD yen. So I'm looking for a final stretch, as I said yesterday, into a high to sell. This thing gave us a nice weekly opening range break to the upside. So inherently, you're looking for that Thursday, Friday high. Levels of importance. The magenta line that you see here is the yearly open. That yearly open comes in at 86.97.5, 86.98, let's call it. Basic trendline resistance off of the highs from June. Come right in that region. If we take an adjusted median line formation, so it's basically a pitchfork adjusting the slope to the primary trend line, you can also see really nice pivots. Almost caught the exact low. Upper median line parallel, also there. A sneaky little trend line no one knows about is also this. If you take a trend line off the October and January lows for 2014, early 2015, again here on that stretch, obviously the August 24th drop was completely, a paramount. And then you saw that support, minor support, break, now resistance. So all of it's lining up. The yearly open, trendline support, upper median line parallel, basic trendline support turned resistance, all in that region right ahead of the 87 handle. Momentum still has a little bit more before he tests 60 as resistance. And remember, this pair hasn't seen a 60 break in resistance since early 2015. So from here, here's what the 30-minute looks like. I know there's a lot on here, guys, but I'm going to break it down for you real quick. There's a couple things. So, again, we're striping into that region right now. Ooh, on some nice divergence. Damn, we might have just missed the entry here. Yeah, so there was actually a nice trigger up there. How far off are we off the tie right now? 83, 14, pretty close, but I think you get another opportunity here. So here's a nice trigger I would have been looking for. Here's a nice near-term resistance trigger. Let's see if that breaks and gives us a lift to the upside again to get us back on a little bit better of a rate to get short at. And here's momentum, still constructive on the 5-minute chart. But looks pretty good here, guys. Okay, too early to tell, but something I'll be considering here. And you can see nice little confluence here on the 50 level. Okay, so here's just a quick update. This is how I kind of like walk through it on the 5-minute charts. So here's what I'm looking for, okay? Into the US session. What's the high day close here? Don't have anything near term. Okay. So I'd be looking for a rally back towards the upper median line parallel, or as close as I can get to take a stop against that high that allows me to put an ATR of 30 pips. Okay, something important to keep in mind. Always, your stop is most paramount. In fact, yesterday, guys, while I was sitting in the courtroom for all those hours the last couple of days, I went back and I reviewed some of the notes and some of the things that I have been tracking for opening ranges and some notes back in the day from The Logical Trader. I tell you guys about that book all the time by Mark Fisher. Great book that really outlines it. And we'll be looking to see if the opening range offers us a move here in CAD yen to open up the session for U.S. trade. One thing I wanted just to note that we don't typically talk about a lot here in the webinars, guys, but when we're looking for those opening range breaks, if you take the definition of the opening range strategy as highlighted by that book, a couple things you want to note is this. A, you got to take into account time as well, not just price. Now, I always tell you, you want to stress the price when you look into opening range. You want to stress the high and the low for a given time period. But we also want to judge the break not just on a spike. Okay, the break needs to assume and assert some time above that opening range for us to get a little bit more comfortable on calling the break valid. As it pertains to the logical trader, if you're using a 20-minute or a 30-minute opening range, that book dictates that you use 50% of that opening range in time to validate the break. Meaning, if you're using a, let's just say for argument's sake, you're using a 20-minute opening range for the session, once that 20-minute high or low has been achieved, a break of that high or low needs to be accompanied by 10 minutes above that region to validate it. Now, my problem with that is that in near-term trading, and especially in the markets that we're in right now, a lot can happen. A lot can happen in 10 minutes, and you'll end up missing a large portion of the move. So we don't want to be quite that stringent. Remember, those his use specifically, Mr. Fisher, is in the commodity pits and a little bit different of an animal from trading 24-hour FX. But just something that you want to note. On a spike above the opening range high, it's not necessarily when you want to validate it. So looking for the Aussie or the CAD yen here to possibly give us another push higher into U.S. trade to get short. Broadly speaking, you're marking some divergence all along these highs, higher high, higher high, higher high, all equal or lower highs here in momentum. So we'll be looking to see if we can get a short exposure for CAD yen heading into the US trade session. Okay, major support near term, or at least the near term bullish invalidation level for the broader advance here. You got a couple things to look at. First, basic trendline support off that low from last week coincides with a nice pivot in price, which was last week's high. That's 86.28. So right now, that's right here. And then you have a whole bunch of trend lines, the 50 line of the current operative slope that we're working with, and then basic trend line support off the February 24th low coincide right here below yesterday's swing low. And that's just below 85.79, 85.80. So nice clear-cut targets. For me to continue favoring or continue to even touch the long side, guys, we'd need to clear this region here, 87.36. On the daily chart, it's much cleaner. That is the 100% extension off the low, so that's 2 equal legs off the low. Also ends up being a nice 50% retracement. This is longer dated off the low from 2009, I believe. Yes, January 2009. And it's pretty darn close to that low we made on August 24th of last year when you had that massive drawdown in equity markets. All right here. Okay, this is the break we need to continue favoring the long side. And I do think inevitably you do get it, but right now, you're at risk heading into that new high. Any questions on CAD yen from last night? All right, we are running low on time, so let me jump into the euro dollar, Craig's euro Oz. If you have a chance to go over SPX and the German 30, especially, okay, looking for angry. Okay, Mitten, I'll try to take a look at those. I don't know if we'll have enough time, but I'll do my best. Here's what euro dollar looks like. First on the daily chart. Look, this thing is messing with a big, big break. And I don't, as I said earlier in the week on the radar charts, I even questioned it. Is it a breakout or a fake out here? Here's what euro dollar looked like a couple days ago. Whoops. Breakout or fake out, okay? Scalp targets aren't too clear here, as I noted, but the topside objective levels are exceptionally important. We've already taken out two of them. The first one was the high day close for February. That was 113.20. That was the first level that we highlighted here on the, what was this, on the 29th. The second level of importance is going to be the outside day high day reversal close from October. That's 1385, and that's what we're checking right now. Okay, so again, the October high day close ended up being an outside reversal off of the high. That closed right here at 1385. We're taking that out now. Next topside target, May high day close, and that takes into 1442. Listen, guys, I mean, I know everyone and their mother, for some reason, is still bearish euro, but we're following what price action is saying, guys. And really, for me, I would not be surprised to see this thing at 115 before it turns over. Okay, 115, by the way, is the reversal day close for August. So subsequent to the high of the year, the reversal day close, or the high of the month rather, the reversal day close was right here at 1511. That, my friends, coincides with basic trendline support, turned resistance, and the current operative median line off the lows. Okay, so the levels are exceptionally clean. The bullish invalidation level is not until way down here at 1255, and I know it's a bit ways from where we are for the euro, which only has 100 pip ATR, 105 pip ATR on a daily basis. But guys, textbook. Okay, really, really clean. Again, I'd be remiss if I didn't warn you guys about trying to get cute on the euro dollar here heading into the end of the month or heading into the end of the quarter. But as it stands right now, again, you want to be very mindful of the fact that you would possibly look for a near-term pullback on this before getting on back on the long side, inevitably looking for that stretch into 115. Any questions on the euro dollar from where we are right now? Again, this would be a consecutive 4-day ascent here to the upside. Fresh yearly highs. Okay, for Mr. Craig, Euro Key, my man, let's take a look. I actually have not checked that out as of late. Okay, so you can see this pivot here. This is 618 retracement from the ascent off the lows that you made in December of last year, and it encompasses all of this year's trading action. Also, a 618 extension off that same ascent has been a very nice pivot in price. You can see it capped the advance here on a closed basis in December. Nice pivot here on a closed basis in February. Here we are acting as support. And again, bring it into a line chart. It becomes a little bit clearer here on some of the pivots that you see. Break, resistance, now turn support. From here, see what the 30-minute looks like. Yeah, I would expect to see a little bounce here, Craig. I would expect to see a nice little rebound here. A, because of the nature of the rebound that you saw here. Immediately, like right now, you might move a little bit lower, but I'd be looking for long triggers here. Take into account a couple of things. So let me take a caution first. Obviously, momentum holding at 40, at 60 like this is resistance, pretty rock solid for the week, is something that you want to be mindful of. On this pullback, I want to see support start to hold at 40. But on a trade like this, I do think you can get a little bit of a rebound. If we take a look at Kiwi dollar, that's been just radically out, insane bullish. You're checking the 50% retracement. This is off the high that you made in April of last year. So, Craig, if we do see another spike high, I do look for a pullback here, at least near term in Kiwi, which could give Euro Kiwi the upside approach. Let me just take a step back here real quick. I do want to see if there's any types of extension that's defining the highs that we're making right now. And that's the ring of U.S. Open here in the United States, guys. We're going to wrap it up here momentarily. Okay. Okay, so at this point, let's just clean this up. And I know it's a 30 pip range, but I do want to highlight this entire region as is. Remember my favorite confluences, guys, whether it's 100 off the high and a 618 off the low, or vice versa, or 50 off the low and 100 off the high, or vice versa. These tend to be really nice regions where markets can find some serious cushions of resistance and support. So I'd be looking for an exhaustion near term somewhere in this region to offer a near term pullback. And again, that's how I would translate it, Craig, into a Euro Kiwi trade. I obviously like the long side of Euro, have liked the long side of the Euro since the start of the year. So I don't want to necessarily encourage you to start looking on the short side for Euro Key, despite this breakout. But near term, I do think if Kiwi pulls off, you could see a little bit at least of a near term rebound here on the Euro Kiwi trade, which is coming off that near term support. All right. And one other thing, I just want to see if there's an embedded structure here. Bear with me one moment. Yeah, look at that. So even on the near term, guys, just an embedded structure off the highs for the month gives you a median line rebound again at that confluence support where we just rebounded an overnight trade. Or actually, this was yesterday. This is on 29th. So does that offer some clarity on that, Craig? He says, thanks, Mike. You're more than welcome. Look, the breakout zone that you need for initially to at least give you conviction that you're getting a near-term recovery is going to be right here at that 50, say 65, basically, 64.96. If we break above the upper median line parallel and kind of clear that region of pivot that you look at 65, essentially just under, then I'd start to look for a more substantiated rally back towards the upper median line parallel. It gives you another 100 pips of play, wide range ATR, and could be a nice little scalp there. So I hope that helps. Again, keep in mind that wider range ATR. So, guys, in wrap-up, we are over on time. I do apologize about the discrepancy in the times for this week's webinars. I got, obviously, again, out of my hands with the jury duty stuff, but that's done and with. Look, expect some wild price action, especially as we get into the end of the week here, and specifically heading into tomorrow, non-farm payroll report. A quick recap on what we're expecting there. Okay, so a quick recap on what we're expecting tomorrow. Non-farm payrolls are expected to come in at 205. This has been revised down a couple of times since the start of the week. Just want to note that. So the expectations are right now for 205. Unemployment widely expected to hold at 4.9%. And the average hourly earnings are something you'll want to watch. This is how one of the things that the Fed looks for wage inflation or wage growth. And certainly that's been one of the limiting factors that you've continued to hear the Fed continue to cite as a major sort of concern that they have for everything that's going down in the labor markets, which have essentially reached the quote-unquote natural rate of employment, right? So that's something you want to be looking at. Also, we will highlight this on SB Squawk as soon as it comes out, labor force participation. If this drops to a 6 point or 62.8 or 62.7, and you see unemployment drop to 4.7 or 4.8, that's not a good thing, guys. Okay, and again, these caveats in the unemployment report is always something that you want to be in mind of. So if you see the labor force participation contract, don't mind any contraction that you see in the unemployment headline figure. It's really going to be on the broader gains that we're seeing for the month, and if labor force participation is able to hold or expand. Even if this goes to 63% and this upticks to 5%, that would be a good thing. More workers returning to the labor force, which is something that has been an ongoing concern for the Fed. So just a caveat there as the dollar index eyes down the lows of the year and the lows from October. Again, a break below that median line, guys, this thing could get pretty ugly. But if we do get a tag of that median line as support, I would expect a little bit of a near-term recovery to offer re-entry back on the short side. Guys, we're going to wrap it up here. Best of luck trading tomorrow's NFP report. We'll try to keep you updated on SB Squawk as much as we can. Have a great weekend, and we will see you on Monday. Cheers.